this is a really good case study on three stocks that we've owned. They were quite sort of core holdings within the fund that we've identified based on the metrics that I've described before. We bought them, and I should mention that each of those stocks at the time wasn't a very exciting story or a stock to own. Their share prices were down massively and nobody was interested. Yet we found businesses that really ticked all the boxes for us, and we were super excited to buy these. So I'll just quickly highlight what they all share the same characteristics. So Silk Laser Clinics, again, second largest skincare clinic network in Australia. As I said, that's an industry-leading position. Founder-led biz, ticks the box. Had a very strong balance sheet, paid dividend, was very profitable. And what happened was 2 years ago, late 2022, there was a very negative sentiment to the retail discretionary sector, and that was essentially put in the same bucket. We managed to buy this really great business on 4.5 times EBITDA. We identified that Wesfarmers, through its acquisition of Priceline and skincare clinics, was the ultimate acquirer. We actually wrote about it, and then 4 months later, Wesfarmers bid $3.25. We bought it for $1.75, so we made a lot of money. The next one was Symbio. That was last year. Again, a leading T1 telco software provider, mostly in Australia. It's a very strategic asset within the Australian telco industry. Founder-led business, managing director and the board owned 22%, so tick. Strong financials, recurring revenue. It had a very strong balance sheet. In fact, 40% of its market cap at the time that we bought it was in net cash, which was quite phenomenal. It was still super profitable at the time. And then 2 years ago, what happened was they downgraded in late 2022. We sort of identified and spoke to the company and saw the downgrade not as a structural issue. It was really a once-off issue as an overhang from the COVID lockdown era. And so we managed to buy this company on 3 times EBITDA with 40% net cash. We then wrote about it and we identified it as a classic takeover target for either Superloop or Aussie Broadband. And 6 months later, actually both of them fought over the company and they bought it for $3.15, Aussie Broadband did. And so we made a lot of money there. And then finally, Pacific Smile, that was more recent. So that was end of last year. Again, the second largest dental care network in Australia, ticks the box, industry-leading position. Although the management team wasn't the founders, the founder, which owned 10%, led a strategy previously to change the business strategy towards returning to profitability. So that was kind of a tick. Then we had a strong balance sheet. They were in net cash. They reinstated dividends. And finally, after coming out of the COVID period, they finally saw strong growth in both patient revenue and also in EBITDA. They had the 28 million of EBITDA. Now in late 2023, basically had a bunch of funds that got stale, smashed the stock to $1. And we managed to buy a business that historically traded on double-digit EBITDA. We bought it for 5 times. Every dental business on the ASX got taken over in the past. And so, we could see that this will eventually get taken over. And pretty much, I think it was 2 months later, we got a bid at $1.40. Then 3 months later, we got another bid at $1.90. We sold out eventually, and it's still going through a bit of a takeover thing, but we made a lot of money at the time. And then there was a bid at $2.05, which got rejected, but we already sold at $1.90 at the time.